All right, so let's check everything. Seems like all is going
I
well.
see you. I see you're live on X, Cena.
Yeah, but I see an error for you. So let's check that. But hi everybody, thanks for tuning in. We are doing an emergency meeting about the market because especially last week, a lot of people were worried about the health of the bull market, and there is a ton of takes out there that people think we've ended the bull market, and a few high profile people have sold their coins ready for the bear market, and the other half of the market is still believing in the bull. So we wanted to discuss what everyone thinks about this and share some data points about that, and and get some insights about it. Hi everyone. Hi Reno. Hi Plancy. How are you guys doing?
Hey, Sina. Good to be here. Hi, Plan C. Such a pleasure to be here with you as well.
Yeah, thanks for having me, guys. Looking forward to the chat for sure, and yeah, lots to talk about. And I think a lot of people are wondering to a degree. I mean, everyone's situation is very different. Like you have a percentage of people that already think the top is in. I mean, I think there, like Cena was saying, high profile accounts that have sold, a couple of them, anyways. And then yeah, I think there's a lot of people that are just holding regardless. Like you have your long term holders that are just don't really care because they're not selling. There's obviously a lot of those people, but even those people I think are interested because they generally follow Bitcoin, and even if they're holding for another 5-10 years, they still want to kind of know what's going on. And then there's a lot of people in between, I think, and that's kind of like probably who we're speaking to the most today, or at least who would probably be the most interested, is people that are just wondering. Like, I mean, everyone's wondering, right? Like, is this time different? What's going on? This bull market has been, quote unquote, boring, or not, not as extreme as the past. So, yeah, well, lots to talk about today for sure.
Yeah. So it and it's important to realize, like, every time the price acts bearish, analysis follows the data, follows the price. So when price goes down, a lot of analysis come out and say we're done, and the other way around as well. So and the moment we begin going back up to 120, 130, then people are going to say, okay, my analysis shows 200k, 300k is in sight. Hopefully we won't hear much more about 500k, 1 million this year. I still have to find Samson Mao and see what's happening with this 1 million prediction. But this always happens, and if one important thing is to realize that a lot of people just do that, and their analysis is a derivative of the recent price action, which means it's not adding any extra information to you. We want to understand if there is like some important, some fundamental, some causal factors that can explain potentially the market's health. And for that, we look at a variety of things, uh, including on-chain data and macroeconomics, and different models that we have developed, so on. And we try to kind of pull all that information together and see where we are. I'll quickly mention that a lot of the stuff that we will cover today, we also publish in our Bitcoin Intelligence Report. It's a weekly report that, uh, how can I? Yep, it's a weekly report that we publish on 21stcapital.com/BI. If you want to take a look at it, join there. You can try for free. And that includes weekly deep dives into all the data we can find about Bitcoin, and also other charts and models that should be helpful. But to get started, I think our report has highlighted bearish signals from the on-chain data in the last few weeks, and that's contributed by Wizard, and he has been right uh, all the way down. But at the same time, I focus more on longer trends and macroeconomics, and I still see strength in the market, even though we have the volatility coming from tariffs. But overall, their liquidity flow is so strong, and the potential money supply expansion is still going on, and it's going to get worse in terms of more spending, more expansion. That these things might actually counteract any potential cyclicality in Bitcoin. So we have this divergence, at least in my mind, that the long-term pattern is now different than the short-term pattern. On-chain data clearly shows demand is weak. Futures data doesn't show we still have capitulation. Recent bounce in the last few days was accompanied with a bounce in funding rate, which shows a lot of people are taking on more leverage to bet on the bottom. Not a great sign. And you see a lot of whales that have held coins for 5-10 years. They are selling, and even with all that, we still don't see price showing a price being well below cost basis of people, and no, we're not showing realized price indices showing rapid capitulation. We still doing that, so we kind of have a medium strength of selling. But if we did have extreme levels of selling, we could have said we are likely close to a capitulation event, and confidently you can say things are the crash is over. But on-chain data is not extremely helpful at this point. I guess not extremely constructive on the market at this point. It's showing weakness, but more, I guess, in the longer run, what determines where market goes is macro, right? So now today, it's really good that we have, Plan C as a full-time analyst in this space, but also Renaud, who has been carefully tracking everything with liquidity, the Fed, the monetary mechanics, and all that, which is the main driver of what Bitcoin does. So we will talk about these things. Let's first get everyone's take. What are you guys thinking in general about the bull versus bear? I know Plan C was doing some polls, and he has he has some thoughts on that, and Renaud has been looking at the broader market. So what do you guys think? Let's maybe start with Plan C. Is this still bull market or bear market?
Yeah, I mean, from my perspective, I have focused a lot this cycle on analyzing and modeling as best as possible Bitcoin's long-term patterns as far as Bitcoin itself, right? So in a vacuum, right? So like let's look at this in two different things, right? So one is Bitcoin in a vacuum, and when I say Bitcoin in a vacuum, obviously that's kind of impossible to do because every last pattern and cycle would have been factored in macro and other factors. But let's just look at Bitcoin's patterns. So the overall long-term trend of Bitcoin is a stabilization of a network that's gaining adoption, right? It's kind of a network of networks. And this network, went from a very small market cap to a $2 trillion market cap over the last, 14 years, right? 15 years. And so what we've seen is a very clear pattern of diminishing returns for the top 50% of the data set. And the bottom 50% of the data set has followed a power law. And so a power law accompanied with a decay function. When I say decay function, essentially there's an element of volatility decreasing, stabilization, and network adoption. Like this is what we'd expect to see with a network that is following a power law and is over time stabilizing. So those patterns are very clear to me at this point, right? You can look at it through volatility, you can look at it through returns. There's different ways to analyze this, but in my opinion, from everything I've looked at, I spent a lot of time on this. The top 50% of the data set, and I really like the quantile, we've talked about this before, but the quantile lens of looking through it, because you can break down what percentage of time we've been above and below different levels. The top 50% of the data set follows a clear exponential decay or a stretched exponential decay. And the bottom 50% has followed a power law. And so when you look at that, you basically say, okay, based on accounting for diminishing returns, which this model does, there's no indication from the long-term best ways of modeling Bitcoin to indicate we're near a peak or at a peak. Now, the biggest thing is looking at the overall landscape we're in. Okay, macro wise, and these are the things I'd love to discuss with you guys today, because this is the stuff I want to learn the most about, to understand kind of, okay, these are the clear long-term patterns of Bitcoin. And like even during these black swan events, right, like COVID and even the FTX collapse and Luna collapse, we went down to the bottom quantile, right, the very bottom there. So even with a black swan, we stayed kind of within this range. And so the question now is, right, like if you look at this model, I mean, we're basically in the middle of the data set. There's nothing to indicate we've had an extreme, blow off euphoric peak. And this is accounting, like I already said, for diminishing returns. Some people would say, well, maybe we're not going to get up as high as we did in the past. I mean, of course that's possible, but because the model does account for that, and there's two different variations of this model, but they're pretty similar. My major question is, macro wise and liquidity wise, I guess my question for you guys, would you say we've been in a net tailwind or headwind since the beginning of the bottom of the bear market? So since we went to 16,000 in 2022, end of 2022, we're coming up on 3 years of being in a quote unquote bull market. Have we done that despite being in a headwind this entire time? Meaning, like monetary policy globally, all these factors, liquidity wise, how would you categorize the headwind or tailwind we've been experiencing since the very bottom versus 2017 and 2021? Because like we've seen gold, do really well. We've seen NASDAQ do really well. And there's some deviation from that from Bitcoin. So there's a lot of questions there. But my question is mainly around macro, understanding liquidity, gold, what gold's showing us, what NASDAQ's showing us, and just kind of understanding where Bitcoin is relative to everything I just said there. Because from a pattern standpoint, it doesn't look like the cycle's over, but I'm trying to understand like the macro element. So yeah, I'm interested in your guys' thoughts. Sorry about the long rant there.
Yeah, I'm going to chime in, Sina. So yeah, basically that's a great question, because if you think about macro nowadays, it's all about refinancing. How well are you able to refinance everything? And that kind of defines the monetary mechanics part. So if you're able to refinance and provide credit, you provide liquidity. And I hate to be the boring TradFi guy here, but just to understand a little bit of the monetary pipes on the system, it's all about a collateral. So we do have a system that relies on using especially short-term U.S. debt into the economy to provide for credit. So the healthier that market is, the more liquidity it provides. And also, unfortunately, we have a lot of misinformation about what is actually tightening, what is actually what is actually QT. Are we really tightening anything? So are we expecting to cut rates in a scenario where we already have all-time highs? So that's why the question is, right, despite or because of that? And I would argue that based on the fact that we are on a regime that is totally focused on a fiscal dominance, which brought basically the U.S. GDP to carry everybody else as the U.S. exceptionalism, so to speak, that pushes a lot of liquidity in a way that many call stealth QE. So it's not really about the Fed. That's why if you have such a regime, you can't just put a lever on interest rates and think that you're going to be controlling anything. You do not control inflation by raising it. And you also create a false expectation that actually cutting rates is going to be easing anything or stimulating the market. So I would argue that we are already stimulating the market a lot through high interest rates, which would be very controversial if you say to traditionalists.
Yeah, but cuts provide the psychology, right? So money that's been just on the sidelines may find it, favorable to flow back into the market. in 20, so in the first peak of last cycle in Bitcoin, the bull market, when the first peak happened, a few things ended, I think. One of them was that the inflation picked up and the Fed started tightening. So if somebody was carefully tracking that, they would realize that this whole stimulating process might end, or um, liquidity regime is not going to be supportive from that point on. Also, the GBTC trade ended, so there was a lot of buy pressure that was coming from that. And if you look at the AUM of that ETF, it exactly stopped going up the moment Bitcoin hit the top. So essentially, um, their lack of growth marked the end of the bull market. Um, and it does feel like when global liquidity and global risk taking slows down, Bitcoin also gets hit pretty strong. And so it is possible, I guess, to analyze the global liquidity trends to figure out where Bitcoin might go. And Bitcoin is probably one of the fastest things to react to it. Now, to your point, the Fed has been trying to tighten, but they may not have been that successful, even with high interest rates. But they may be successful in pockets of the economy, right? For example, they have been able to slow down the housing market. It doesn't seem like it's helping prices a lot, but it has killed the transactions. So the market is completely frozen. Similarly, we have a slow action in the auto industry, which really relies on loans and lending. But maybe other parts of the economy, it's actually working the other way, because they are distributing a lot of coupons, a lot of payments back to the holders of treasuries. And so that has lost its effect. But this is like with them trying their hardest to tighten the economy, right? So, but moving forward, they themselves recognize that they are at a restrictive place. So they might be. So the only thing that's left is to try to stimulate the economy on the margins. So they only have one way to go moving forward to reduce the rates. And again, it may not be fundamentally that important, but it has psychological effects. Also, comparing different central banks, the U.S. central bank is behind pretty much many other major banks. They have been cutting a lot, and so if they equalize and they also cut, then some of the interest rate differential effect that moves capital would be counteracted, and so we get more balanced capital flows across the globe. In that sense, I think they may be able to push some liquidity to risk asset. Again, maybe not the actual real economy, but they do tend to impact the risk assets by doing that. And so moving forward, I think there's only one way interest rates can go. Like even in the worst time, which is now, the Fed is resisting as much as possible to rate cuts because they see PCE and other inflation reports, data indicators uh, are not showing any interest in going back to 2%. We've been stuck at near 3%, or different indicators between 2.5 to 3% for 1 year or maybe 2 years, right? So they are just unable to tighten the economy more than they have done right now. It just doesn't work anymore, right? And what they might do moving forward is, if they get surprised with the labor market slowdown, which we have seen in the last 3 months. We've had only 35,000 jobs created in the last 3 months on average. If another report confirms this, like, and we realize that this wasn't a one-off thing and it continues, then all the worry about inflation will just be replaced with worry about the job market. And what Powell said in Jackson Hole meeting was that, in their analysis, if the labor market starts to slow down, there is a risk that it accelerates. And so they really worry about this like spiral doom loop of a labor market getting slower, and then people have less money, they spend less money, liquidity goes down, businesses earn less money, and then they keep firing more and more people. So you get into this spiral down to a recession. And we also have this global giant elephant in the room, which is the tariffs, which is really starting to work and extracting monetary value from the economy. So it's kind of like it's sucking energy out of the economy, sucking oxygen out of the room, to borrow sailors' terminology. So there are reasons to worry a lot about recession now, even though they haven't really been successful in bringing inflation back to their exact target. Now they have a second worry, which can be more important to them than the original inflation. So then they'll have to just drop the rates, even in today's regime, which is sort of against Trump's plans. And moving forward in the next year, every day, we are one day closer to the end of Powell's term, and the balance of power has already changed a lot at the Fed. And with Trump introducing the replacement, um, the balance of power might further change. And after Powell is out, it's over. They're going to be cutting rates way more than traditional economic analysis would suggest, and they try to use every lever they have to drop the rates and stimulus. But more important than that is probably the Fed's regulatory role. So if they also loosen the Fed's grip on the banking system, which they can if they have control and the majority control over that system, they can allow banks to take on much more risk and actually expand money supply with force, and that will be very, very positive for markets. Now, again, all of that basically says we have a one-way street now from the monetary policy perspective, right? And then it's all supportive. Then we get into fiscal, and fiscal is also one way moving forward. And they try to pretend they want to cut spending here and there, but they quickly, turn that into a circus. While Elon Musk was trying to cut like a few $1 million here and there, they introduced $1 billion of extra spending at the same time. So it turned out to be a comedy show. And so when monetary and fiscal work together, this is the golden time, like kind of like after COVID when everything was helping liquidity. And so I see like very positive macro trends, even though temporarily we may not have a really strong sentiment in Bitcoin.
Go ahead, Lindsay.
Well, I just want to follow up and ask a question again here. Like, what I'm trying to quantify, I know it's complex. I totally understand there's a lot of variables here, but I guess I'm trying to distill down and quantify as best we can to kind of give us a reference point to compare to the last two cycles. I think the last two cycles are the most valuable personally, but going back to 2013, it's just Bitcoin was too small of a market cap. It's still useful to a degree, but I like to focus mostly on the last two cycles. So when you look at the 2017 cycle and the 2021 cycle, relatively speaking, I know it's probably hard to do, but quantifying like, okay, headwind, tailwind, what was Bitcoin in from say 0 to 10, just keep it super simple. I know that's hard to do, but versus now, like I guess what I'm trying to quantify is since the lows of 16K, what have we been in? Tailwind, headwind, saying minus 10 is like the most severe headwind, plus 10 would be like the most severe headwind. What have we been in up until this point? What were we kind of in 2021 and 2017? And what would you expect us to be in for the rest of this year and kind of next year? I know that's probably a very hard task, but just to kind of ballpark as best we can to kind of give a way to quantify these macro elements, right? Because that's what I'm trying to understand. I feel like I understand the patterns of Bitcoin very well, like its overall trend, but it's not in a vacuum. These macro factors are huge, and so like the on-chain, there's a lot of value in on-chain as well. But I feel like understanding macro is probably it's worth going into as much as we can here. So, yeah, what are your guys' thoughts on it?
What I could say, even though I'm not able to maybe provide like an exact number on tailwind and headwind is the idea that Bitcoin as being such a small market cap compared to macro, it's actually driven over time for a little different reasons. So it's becoming, in my opinion, something more a composite side where you have the risk on, because until recently, everybody would just say that Bitcoin is just a leverage play on a NASDAQ, and it would be a pretty compelling case. But more and more, you see a behavior, a gold-like behavior, a commodity-like behavior, even a reserve-like behavior. For example, and you see what happened in like breaking up in 2025, and it didn't really move back to 60K or something that you would expect to be completely volatile and crazy. So you see a more stable Bitcoin over time, where those percentages and how it influences the price actually, in my opinion, is way more driven towards a reserve or a commodity and something that is more global, especially when you see the image that bonds in the US are creating to the rest of the world, because people are saying, hey, look, we cannot really trust it if our assets are going to be frozen at any time, because we do have a more deglobalized world right now. So this is where I believe it's going to be a little tougher to just get a number like that onto headwinds and tailwinds, because 2017 was pretty different than we see right now. We just had the ICO craze, and Bitcoin just rode that wave, and liquidity everywhere on speculation. And I don't really think it's the case anymore here. I think it's
so that's fair. So you're essentially saying there's really, it's not the right question really to be comparing the last two cycles at all. So essentially, we need to quantify within each cycle and maturity, where Bitcoin's at. How has it shifted? Like, what's the phase shift with Bitcoin as far as the major influences on it? Because it is, I do agree, over time, it is absolutely morphing into being something different, right? Like every cycle, and this is the thing, like we've seen these consistent patterns for Bitcoin since its inception. We have seen pretty predictable 4-year cycles type patterns, and the last 3 peaks were in the same part of the year. Like we've seen these kind of almost like odd how cyclical Bitcoin has been. But I totally agree with you that every single cycle, Bitcoin has been a different thing. Like it is a mature, it's like comparing a kid, to a teenager to an adult. Okay, they're all humans,
because it is,
but there are different levels of maturity, and the influences that cause volatility within those different, whatever growth cycles is a different thing. And so I think it's a good analogy, because I agree that Bitcoin, I mean, it is a global asset. It is absolutely a network. And so we are seeing, like you said, it can track the NASDAQ for a period of its growth cycle. And it did. And the question remains, like, okay, so what are the best things to be looking at to assess what are the biggest, proxies to kind of see the influence now at this stage of the cycle of Bitcoin's maturity, right? And this is where some of these past indicators start to lose its value. So besides asking the right questions, we need to also be saying, are we looking at Bitcoin through the correct lenses? And that's really one of the biggest challenges, because you can always find an old indicator that's worked in the past, but it does not mean it will work this cycle. And so, there's some models and things that are more useful, but I like how you categorize the answer there, as far as I think we need to ask, like, what is Bitcoin at this stage? Like, what is it? I think that's one of the good starting questions. And then from there, we kind of narrow down which indicators are most useful, and which where's the best use of our time spent as far as understanding, how it's going to react now. So you're categorizing Bitcoin at this stage as you're basically saying, how would you categorize it again? Maybe just define what you're saying.
I would personally put it in 3 different buckets with different percentages that change over time. So one is the risk asset, right? So a NASDAQ, so a very nice correlation, but I don't know, maybe a third, something around that. And then you also see the gold-like kind of perception on on how it is close to gold. It has been more correlated to gold, and over time, they as a liquidity sponge, so to speak. So if just by sucking liquidity, which is exactly what gold is doing right now, they may be competing on the short term, but I believe they will be more complementary on the long term. And then there is the Bitcoin fundamentals itself that no other asset can do, that differentiates Bitcoin, like the actual adoption. I mean, something that is happening right now, a conflict in Iran or something in North Korea, may be already affecting and actually protecting the network. You guys know it much better than I do, but it's basically what only Bitcoin can do. So though, and everything is playing at the same time, because in my opinion, in the world that we have currently right now, it's literally deglobalizing I mean, not completely deglobalizing, but new alliances are being formed as we speak. And everything that we think we take it for granted won't be anymore. We don't know if capital flows are going to be allowed into the United States, or maybe there is a tariff on capital, depending on what happens to Europe, what happens to Russia, Ukraine, and everything. And I believe Bitcoin is playing a role based on the fundamentals that no other asset has. So I think these are the kind of three buckets that I would look into. And
Okay, so risk. Yeah, risk on or off, is one bucket, like kind of market willingness to take a risk, like, okay, Bitcoin is a risk asset as one bucket, as a percentage. And then you're saying the second one is more so
the gold-like competition, the gold
commodity.
Yeah.
Right, soaking up global liquidity, acting as like almost a risk off, almost the opposite of the first one. Like it's as a percentage, right? It's kind of like acting as a risk asset as well as a risk off,
maybe
to varying
creates
degrees.
a band.
Yeah, and I would agree that naturally we probably will see. It'll be interesting to see over time, right? I mean, Bitcoin is a new asset; it's hard to
it needs more
to say exactly, but maybe there was a higher percentage of a risk off element, and we're slowly starting to increase the bucket of risk off. It was risk.
But let's look at the price action too. I mean, I think everything you guys were discussing is confirmed when you look at price action. And here is one example, right? So you can see that in the first peak of the last cycle, this is where it was. So here, Nasdaq was going up slowly, gold was going down, and Bitcoin decided to diverge, and gold kept kind of stable, perhaps not showing a huge bid on liquidity, but then Nasdaq and Bitcoin decided to go up together. So here Bitcoin was really acting like a risk asset, and then they started after the Fed, signaled the reduction in, like if there was a worry about inflation and the bond market started pricing that, liquidity dried up, and Nasdaq and Bitcoin went down, and they kind of met down at the bear market. Then during the bear market, they were all working together somehow, right? And then all three started to move out of this slump. So gold was up, Nasdaq was up, Bitcoin was up, but at some point Nasdaq was running up while Bitcoin and gold were correcting. So here Bitcoin decided to act more like gold. I haven't looked at like any geopolitical, trend here to say why Bitcoin is now on the same train with gold, but Nasdaq went up, took a break, and then gold and Bitcoin caught up. And then they went up all together. And this pattern, I've been looking at this for a few years, and I keep seeing that Bitcoin at times is friends with Nasdaq, and at other times friends with gold. Like also in the tariff crash that we had earlier this year, you can see Bitcoin corrected pretty heavily. Nasdaq also, and arguably even worse than Bitcoin reacted to that, right? So they both went down together, but gold was just up nonstop. And when these things finished the crash, they caught up with gold. And then they all went up together. So it's sort of like they have the same destination, but at times Bitcoin jumps on this train versus the other train. And that kind of speaks to Renault's and Planci's point that they have this dual. It has this dual role. It is a sponge of liquidity. It's perhaps the best sponge there is, and also it's a risk asset as well. So uh, it benefits from both effects, but with added volatility. Like if one trend is down, that Bitcoin might follow that, but then over time it catches up. That's why I'm saying, like, even the divergence that we are seeing recently, there's a really strong chance that this will be closed.
Yeah, yeah.
Agreed.
Yeah. So have you looked at Cena looking at like an average of the two, like somehow taking Nasdaq and gold and almost making like a composite of the two to kind of as a third, I don't know, indicator or third. I'm not sure if that's useful or not. I mean, it's good to look at them in individually, but maybe there's some use in having almost like a composite of the two, just to compare to where Bitcoin is, relatively speaking. But no, I think this is interesting. I do think, like you said, like it has followed Nasdaq, it has followed gold at time, and yeah, we would expect it not to diverge from both of them for too long, right? So,
And
Yeah.
it's
And in this closer view, it's very clear. Like Bitcoin has been almost like leveraged Nasdaq, like even tick by tick following that recently. But at other times, uh, it, Nasdaq behaves differently, and now more recently, Bitcoin is completely different than the other two. So it'd be interesting to see how this ends. But um, what really is key for me is liquidity. Bitcoin mostly responds to liquidity because its adoption trend also happens, but it's on a longer scale. um, in the year to year basis, what happens is dictated by cyclicality, cycle tops or downs, and bubbles, which we don't seem to have much of it lately, plus the liquidity trends. And as long as macro is supportive, I don't see much risk downside, except if we go up really really rapidly and add a ton of risk. For example, if we look at if on a quantile model we go to 80%, 70% risk range, then I would expect a correction after that. But at this point, I don't see like price bubble much. uh, I do see a weak demand, but also weak sell pressure. uh, and then I see positive macro trends. So I'm comfortable where I am at this point, and I'll wait for a few things to emerge. Either we get a macro pulse, and we have a surge in inflation, which will dictate the bond market and the Fed to stop any sort of QE or rate cuts. That's one thing. Also, if we see tariff effects are damaging the economic growth, while there is no will to react to it and stimulate the economy, which is very unlikely. Or if we do see a rapid rise in Bitcoin's price, which is much faster than you expect from uh, tailwind effects, right? So if any of these things happen, then I'll get a lot more bearish feel. But as long as these are all supportive, and you go on Twitter and half the people they think the bull market is ended, it's all great, man. But the moment influencers come out and talk about $1 million price, that's where I'll get really really worried.
For sure. There are actually two things that I'm tracking in order to understand what's happening on the macro. Do you think I can share something on my own here, Sina?
Sure, yeah.
Okay, so one thing is
Wizard is here.
Oh, Wizard is here. Welcome, Wizard.
Hello,
Welcome.
guys.
Nice to have you.
That's awesome. Sina, would you can you
Yes.
put my screen to the studio just to? So one thing that I look at is for sure the dollar. So this is the DXY, the dollar index, comparing the dollar to other currencies, which is important for us to understand liquidity. And we see that since kind of a liberation day, we created a whole narrative that the US is no longer good. We want to go abroad, and that died up pretty quickly because US markets are also going up. You see liquidity going everywhere. and this reflects on the dollar. It's pretty good to be in the rest of the world with other currencies because in dollar denominated assets, everybody looks much better with a weaker dollar. And the administration actually wanted for that to happen. So, regardless if they were actually able to do this, but we see a weaker dollar. But this here is very liquidity positive because this means leverage that generates the liquidity. But there's a little bit of a catch because the more you generate here in liquidity, this is lent into existence. So this needs to be paid back. So that means that you create future dollar demand, and maybe you won't have enough dollars in the future. That could be one of the true headwinds, in my opinion, which is deflationary. And we see that since July 1st, where DXY was 96.5, we see the dollar going higher. So this is something that we're tracking, but it's still lower comparatively to what we had before Liberation Day for sure. But another thing is what's Scott Besson is doing. So if you see the actual yield curve of the US, that's pretty clear why the Fed needs, quote unquote, to cut. Because the bond market is already saying we want collateral. Collateral is here. It's short-term bills. We need that to drive liquidity, and this is exactly what Scott Besson is giving the market. So we just had $100 billion in 4-week T-bills that are actually going to expire. So they're going to mature in 6 days from now, I think. So a week from now, they're going to need to issue more T-bills. And the more what we call on the run, so pretty fresh out of or minted, right, on a crypto way to say it. So this is exactly what the market needs. This is very liquidity positive as well, and that's what's been happening. And if you see here, the Fed is actually out of here. So the Fed is on the left, right? So the Fed influences this part. So this U shape just means that the Fed is too late based on what the yield curve has already done. So many people just talk about the 30-year yield, that the US is no longer good because it's almost 5%, but nobody really talks about the 2-year yield, that it's at 3.6 and just going lower and lower, meaning that we have a huge demand. Even though we're going to have a huge supply, the demand is much higher. So this, in my opinion, will provide that way for the Fed to actually have a lot of not confidence to cut, because they never use that into their narratives. They always talk about the dual mandate. But in my opinion, this is really what's going on here, and they need to pay attention. The yield curve tells a lot more than any FOMC meeting would.
Yeah. All right. So, Wizard, how are you? We missed you. I know you had other things to do, and we had an emergency meeting, so the planning was hard last minute. But I think I'm glad we all made it.
No, thank you guys for having me. I missed it, and I was not sorry. I was busy, but I tried to make it like next week or the weeks after. Try to put in my schedule. But what's happening, guys? Is it over or not?
Well, we were talking about macro, and we also talked about with on-chain signals that you had highlighted in our weekly report.
Yeah.
And we mentioned that you have been not so positive on the market, and you've been right for the past few weeks. Um, and now we have a divergence, right? On-chain
Yeah.
is not very positive. Macro is still positive. So how can we make sense of that? What do you think about what on-chain data tells us?
I think like not only you guys, a lot of my friends they call me bear, but you know what? I think writing the reports for Glassnode a long time, what I try to do is not to be adding a lot of prediction to the chaos that is going on in Twitter and I mean social media, because a lot of people are trying to say what's going to happen. I'm more fan of giving people the tools that make a better decision long term. That's why it looks like I'm bearish. So I see people talk about 130, 150. My point is, you cannot first of all talk about that. Yes, you might hit 130 2 weeks from now on. Something macro might happen. I'm very agnostic, but I think when they're excessively bullish, they need to have some bearish content to find something in the middle. That's my mission. That's why people see more bearish stuff from me. And I've been quite bearish even before 124. So if you take that part in, I was wrong because I was saying, hey, after seeing 123, it's impossible to go. And hey, market went to 124. So I tried to just be a little bit against the crowd. That's why it looks like I've been bearish. And yeah, like all of a sudden I was right. But I don't call myself right. I see this thing, this bearish momentum was in pipeline long time ago. I was just delayed. And one thing I want to ask everyone here, because I'm not a macro guy, and I see people talking about the cut, like the rate's going to be probably talk about September, but they've been talking about a long time. Don't you guys think we have been pricing this a long time ago and we'll keep pricing it? And when that rate cut actually happens, it's too late and market is going to actually crash because we've been pumping the markets, not only Bitcoin and S&P everywhere talk about rate cut, rate cut, rate cut. And I think not every single pump that we've seen was because of that, but a lot of people hop on this like train of, hey, we're going to have liquidity coming in, and now they're going to get devastated. Don't you think that's going to be a scenario? It's almost too late to get a rate cut.
You want me to
Tina,
go
go
ahead?
ahead. Yeah, go ahead.
Yeah, sorry,
So
maybe you answered it. I just want to come here and ask this question actually.
yeah, I think we had several waves of pricing in different things. So initially, a lot of people were kind of thinking rate cuts are confidently, on the table, and the Fed was also saying we're going to cut several times, and then inflation went the other. The tariffs happened, and inflation went the other way, and everybody kind of slowly lost hope. And the Fed went, I think, from 3 cuts or 4 cuts down to 2, and then 1. And at some point, it was like the odds of rate cuts were completely non-existent. A lot of people were expecting those in July, and June, right? So, but the Fed was focused on inflation for many, many months, and so over time, a lot of that bullishness or dovishness went away because we were seeing the inflation data is rising. So then the market priced in little um, cuts. Then what happened was the last month's labor report. So when that happened, a lot of rate cuts odds came back, came back in the game. So I think at this point, what the market is expecting is definitely 1 cut, which is almost locked in, unless this Friday we get a completely different labor report, right? Um, so that's there. But then the market at this point is pricing a maximum 1 more, and then uh, not a rapid trend towards cutting. So if the data comes in at the same level, showing that we are sort of like inflation is still kind of high, but it's not extremely rapidly going up, and also labor market keeps it slowing, or sort of stays at the same level, we're going to get 1 or 2 cuts. So that's completely in line with expectation in the market. But if labor market is weaker, shows a solid continuation of the downward trend, then we should see more cuts being priced in than the market thinks. So I think, to answer your question, there has been a lot of up and down in expectations, and at some point, market. The reason we actually corrected quite a bit in Nasdaq and the stock market was the market kind of gave up on the hopes to rate cuts lately, and the job market report only brought it back halfway. So I don't see like extreme dovishness at this point, but a lot of people are predicting 1 or 2 cuts this year. So it all depends on what the data says beyond that. So if the data shows inflation is going up and 1 or 2 cuts end up being 0 cuts, then I don't think the market will like that at all, and it's going to be bad. And otherwise, it really won't have much effect because that's in line with what the market expects.
So what's market expectations then for cuts? It's 2 rate cuts, you're saying, and if we come in less than 2 rate cuts this year, that would be bearish. You could say if we have more than 2 rate cuts, that would be bullish, and 2 is kind of neutral.
Yeah, I think September is locked in, and then between November and December,
Maybe
you have
another
this
one.
equal odds between more cuts and less cuts, and it kind of averages out as one other expected. What do you think right now?
Yeah, no, I first find it fascinating, so I totally agree with you. But if you think about it on a fundamental basis, the whole FOMC meeting schedule that we did not have a while ago just became a whole pre-scheduled show. Because if you think about it, if the Fed is actually concerned about the dual mandate and we have such a lousy data from the BLS that created that whole ordeal with Trump and everything, fire in the person, but that data came in like 48 hours after the FOMC meeting. Why why couldn't you didn't have the data before that had a lousy revision, and now we have to wait until September 16th until we have something else. And then the whole market is actually trying to understand the words that are used by Jerome Powell to understand that what is that? Is that more dovish? Is that a little different than before? Almost like a chat GPT like kind of thing. Try to analyze it, and then we just trade. So for short-term trading, it's a smoke screen detector, so you need to basically take a face value. But over time, you understand how little sense it makes, because by definition, to your point, Wizard, it's by definition, you have to look backwards to understand what already happened. So by definition, you would be too late based on the work that you do. And still, in my opinion, still they will cut maybe. So one is if you there should be probably one cut. Some say about that 50 basis points. I personally don't believe so. Maybe another cut, but I still doubt it. Based on the politics and the whole tension, I believe it would drag a little bit more, because there is the whole tariff scare that, in my opinion, is not really does not provide a fundamentals. We don't see anything related to that. The economy wasn't doing well before that. And exactly. So that comment is, is spot on. It just becomes a meme at this point, because it's a monetary policy on such a regime where fiscal, in my opinion, Scott Bessent has way more power to make any kind of influence to the markets. It's a really tough job. It's
Yeah, just to clarify, this for September, 96% of a one rate cut, and by December the market is expecting two cuts, but then 40 with the highest probability, but 42% chance of three cuts, and 10% chance of only one cut, right? But what Renault is saying, it's possible that this is a little bit underestimating. So maybe we get one cut, and after that, inflation picks up, and this kind of staying put after one cut is the base case. So if that happens, then you can say the market is now a little bit more dovish than warranted. But again, on Friday we'll know. I think if we get a bad labor market report, we will be more on this side of things, at least two cuts. And if the labor market decides to actually be positive and solid, it can wash away a lot of the negativity in the last three numbers and sort of reset everything. So this is funny. I mean, data dependent, but also politics dependent, but also, we wing it whenever we want, and sometimes we use politics for to be predictive. Sometimes it just they claim to be different things at convenient times, um, and during COVID, inflation was just shooting up, and they didn't care because they would just wanted to focus on dealing with COVID and stimulating everything. Why would you stimulate the housing market? Why were you buying So they were like extremely focused on employment side of the mandate. They completely forgot about inflation. Now they claim we worry about inflation more. Now recently they said it's equal. It they it's a show, it's a complete show, and it's terrible that a small committee is deciding important, super important things about the economy, and it's a private club, and these people are really happy to be in positions of power and make decisions that are frequently wrong by their own admission. And this is the best they can do with 400 PhDs and having all the data in the world and so much money spent on conferences and discussions and research and salaries and lots of meetings and infrastructure and all that. And that's what comes out of it. I think if they just didn't do anything, they just let the market do this stuff, that would kind of be at least as good, or probably way better.
And what's interesting is if it works, if something works as intended, that means that their measures were okay. There is a causation to the correlation. But if not, it just takes more time for that stuff to actually kick in. So you can never actually be wrong and at the same time just create a whole narrative that you are in control of something that you're really not.
And then there's the national housing emergency thing, and we'll see what. It's very interesting that they claim that, so they are doing anything and everything they can to push the rates down, and probably the Fed is doing the other way. So it's funny how both sides are, I think, fighting a political fight. But yeah, so looks like the market is in a very complicated, complex place. We are looking for fundamentals in Bitcoin and the demand to return. We're not seeing capitulation level sells, which we like to see. At the same time, there is fiscal and monetary support coming online. So two forces are at odds right now with each other. My personal guess is I really don't care about what happens in the next few months. I'm focused a lot more on the longer term, and if on the longer run your view is positive, then any dip is basically a accumulation opportunity. So that's how I look at it. And most of the time, you are better off not worrying about short-term volatility.
Yeah.
Totally agree.
What do you guys think as your final thoughts? We're almost 3 minutes away from 1 hour, so I think it's a good place to summarize or make some conclusions.
Well, I think I'll go ahead because I was sorry I was late. I had a lot of charts to discuss. I'll just go bullet point by bullet point. I think I put out the thread a couple of weeks ago about M2, BTC, correlation, excuse my language, bullshit that was going on. And I tried to discuss it, and I think I showed it. And a lot of people before me did it. I'm just 100% sure they just get the attention. It was just my luck. People looked at it a lot. But if you look at the 3 months, 6 months, like systematically approach this, I mean, statistically look at the 3 months, 6 months, yearly, monthly correlation between the M2 and give it different lags, you cannot find any pattern. Like literally, it's random. And that was one of the big, it's just so.
But Wizard, M2 is liquidity. It's just money that goes straight into Bitcoin. Haven't you?
That's what I really wanted to. Probably next week I'll discuss it. And the other thing is, I tried to get the data to start to study the correlation. I figured all of prominent data provider for M2, they're providing on a monthly basis. There's no weekly, daily, hourly data on M2. But people are showing the BTC price daily, hourly, and put it next to M2. Then I was
asking, how I figured that out? I tried to reconstruct that metric, and I'm like, how the hell are these guys doing that? The central bank of XYZ is only providing monthly.
They think it's on chain.
So then I went back. The highest resolution is available is weekly for US. So they're talking about liquidity, M2 and BTC. They're not explaining, hey guys, this is a monthly data. And they're not providing information about is it like 196 country or a G7, what country it is. And they're not saying in order to produce the daily data, they're using the DXY to value and interpolate the data between today and 1 month from now. So the chart you're looking at is actually showing the correlation between BTC and monthly data of the M2, which has interpolation, which is literally inverse of DXY. So you're looking at the correlation between inverse of DXY and BTC, and you thought you found something interesting. So that was the biggest thing I was about to talk to. And then I had a back and forth with Plan C on Twitter, and a lot of people. I see a lot of discussion about bulls is over, bears is over. I think before we get to this discussion, maybe next week, we should think of what is your definition of bulls and bears. That is where a lot of fights is actually going to end. Someone is defining bulls and bears in terms of price only. Say whenever we have 50% drop, that's bear. But someone, especially on-chain analysts, they look at the on-chain metrics and they define bear market as literally liquidity inflow to the market is negative now. You might see price going sideways or even jump a little bit on a weekly basis, but liquidity or realized cap, for example, is declining. So if we have some sort of discussion next week or the week after to define what is bear market, what is bull market, then we're going to have some understanding, is it bear market or not from on-chain perspective. And when I'm saying on-chain perspective, it's not like a written rule that you go look at it. It could be 100% my opinion. A lot of people might look at the same data and come up with totally different conclusion. From my perspective, as I put it in Glassnode reports on a weekly basis or other places, if you look at the data since even the second rally to 124, it was like amazing to me, because when you look at the amount of profit being realized this cycle, it's just ginormous. If today we go ahead to I would say my base case for bear market would be true market mean, which is around 70 something thousand. I'm not saying we're gonna go there, guys. Like, don't kill me. I'm saying, let's say if someone was put gun to my head, say, hey, say where is the bear market? We're gonna see a bear market. You gotta give me a number. I would use true market mean. For everyone who are interested, is literally looking at the average cost basis of the active investors minus the dormant coins that Satoshi had, like literally the coins that change hand. If you look at their cost basis around 70 something, 77, 76. If you look at that cost basis as a base case for uh, uh, a bear market, you look at the previous markets, you could see every cycle we are seeing less volatility around that mean value. So long-term volatility is declining in BTC. That means our bear market most likely is not going to be as deep as what we had in 2000, I don't know, 18, 19, or whatever we had in 2022. That's my base case. We're going to have shallower bear market, but the bear market's pain is going to show itself by the time component. I believe so. The time component of the bear markets are going to be what's going to bother people. And the other thing that I see is going to be a bear market is people are so married to the idea of 2021 is going to happen in altcoin market. Now they're seeing it's not going to happen. That's where the pain is coming from. If you look at BTC, we have been only 10% below the all-time high, or I don't know, 9%, 10%. So that pain you're seeing on Twitter is because they had, I don't know, I'm not going to name 1 or 2 million coins and see. Probably one of them is 90% down dollar wise or 100% down BTC wise. Now people are feeling the pain. That's what is causing people to feel this bear market, not seeing 2021 when they were printing money on a second basis, I would say. Now they don't see that money being thrown around and their altcoin is going down in BTC term. That's where the pain come from. In midterm, as I put in most of reports, I think the short-term holder, the one that bought in last 6 months, especially after price broke below above 85, 87, all the way to 100,000, you had a sharp move up there. We had people jumping in and start to buy. Those top buyers are pretty resilient. I was expecting to sell and we see capitulation. That's where my bearishness was coming from. They were pretty good. And if you look at the charts are showing the heat map after breaking below their cost basis, which was around 107, you'll see, I'm sorry, 115, 116. You will see they were buying not exactly the same investor, but I'm saying We saw it by the dip over last couple of weeks. Yes, you could see they're buying it, and it is fascinating to me because it looks like there is a patient buyers group of buyers in this cycle, which amazes me. Every time we're seeing price dropping, I was saying, hey, this is the dip that they're going to capitulate. We're not going to see a lot of buy pressure. And but every time we're seeing it, so that's amazing to me. But it's still, that's not going to reduce my bearishness because, from my perspective, liquidity, at least rate of change in the liquidity have been declining in last 3 weeks. So where is going to be the bottom? I don't know. I'm not going to speculate. For me, something around 93, 94 would be amazing to see. But gone to my head, my bear market base is true market mean, which is around 77.
And that's 40% drop.
Yes. Like let's say something macro happens and things just lead to another thing, and we have a lot of debate about okay rate cut, and people are going to get less effect from increase in liquidity on BTC. Probably they're going to get even more disappointed. In that case, seeing 77 would be, for me, would be Armageddon. But 94, as a person who is looking to increase his BTC, would be early Christmas for me.
Agreed. Hope it happens.
Yeah.
Any points, Clancy?
Yeah, just to piggyback on some of the stuff you just said there, because we did look at that in the morning stream we did right before this. We were looking at the true market mean and also the short-term older cost basis. And yeah, I mean, right now, just to recap for anyone who is not aware of the short-term older cost basis, it's at, I believe it's at around 109. And yeah, Wizard, correct me on any of this stuff if it's incorrect, but
No, you're
109,
right. It's 109. Sure.
yeah. So I mean, we're just above that. We're basically, we're at 112 right now. So we're basically just above that. And this short-term older cost basis, I think, is a very useful on-chain metric. It's basically a way of looking at the cost basis of the people that bought within the last 155 days, or all the coins that my understanding is all the coins that haven't moved in 155 days. So they're pretty new people in the market, all right, and so essentially, we're just above that, and it's also very similar to the TA metric a lot of people like, which is like the 20-week simple moving average. So, during a bull market, typically you see bouncing off or bouncing near that area, maybe going slightly under, but recovering very quickly. Like you don't spend a long time underneath the short-term older cost basis during a bull market, typically. Or below the 20-week simple moving average. So it's a kind of a bull bear, you could say, somewhat metric where you either bounce off of it or you go a little underneath and recover quickly. And then as far as the true market mean true market mean price goes, we did go quite a bit below that in previous bear markets, but I actually am more aligned with what Wizard said. I don't see us going way below that. I really don't. I mean, unless the only way I see that is if we have a very strong parabolic peak similar to what we saw the last two cycles. If that does occur, okay, maybe we need a longer correction, maybe we need a deeper correction like we had in the past. But I would agree with him that especially if we don't have a parabolic, if we don't have a parabolic peak, then yeah, I could see us going to the true market mean or a bit below it is probably would be my guess, so to speak, educated guess. I'm more in the camp of a bear market. If when it comes of 40 to 60%, I really don't see we see these 80% corrections like we saw in the past bear markets. These really deep capitulations. Just where Bitcoin's at in its life cycle of adoption and stabilization as a network, volatility is systematically going down every cycle. To the up and downside, that will affect the upside and the downside. So just like we have diminishing returns, no one can argue there's not less volatility and diminishing returns from cycle to cycle. That's a clear pattern you can look at statistically. So factoring that in, which the Quantile model does do, there's no signs that we're kind of at the peak of the cycle, at least from a regression standpoint. On-chain is a completely different, that's a completely different lens of looking at Bitcoin through. But anyways, just to wrap it up, I mean, my main things I'm looking at, as far as the macro element, all the things we talked about today, I think that was really good just to kind of listen in and to what you guys had to say on that. I do agree that is such a massive X factor and such a hard thing for people to wrap their head around. And because a big part of that is how are you getting that information from? The interesting thing about on-chain data is you can just look at it yourself, right? Anyone can look at it, and then it comes down to how you interpret that data. But the data is very clear in how it's presented with on-chain. It's just, this is the data we have. With macro, who are you listening to? Where are you getting the information from? Like, how is it being massaged? Like, what's the narratives around it? Like, it's so much more going on, and it's so much more narrative driven. So macro is a bit more challenging to interpret, and it's a composite of so many different data points. But for me, to wrap it up here, I mean, the 4-year cycle narrative, I do think is going to become a really, like, these last 4 months of the year, just given how the cycles have played out, given how the peaks have been in November, December, the last 3 times, I really think we're going to start to see a lot of people, like, yeah, there's people now questioning if the cycle's done, but in the next couple months, there's going to be more and more discussion around this. And so, like I've already said in I think maybe even on this call, there's going to be sell pressure towards the end of this year, regardless of what the price is at, just because there's 50% of the market, say, as a number, that believes in this 4-year cycle. So how we respond from that, and how, if we have this, like, there basically, are we going to have enough demand for the rest of, like, is macro going to get bullish enough, or headwind enough, or sorry, I should say tailwind enough? Is macro going to get tailwind enough, and is there going to be enough bullish narratives in the market to sustain the inevitable sell pressure we're going to see from the people that believe in the 4-year cycle, right? So there's going to be a dynamic that's going to happen here with the rest of this year, and then early into next year. Do we have enough to get over the hump? We've never done it in the past. Every cycle we've basically haven't gone over. We've ultimately gone into a bear market. So sorry for the long rant here, but I'm more aligned with what he was saying with regards to, if we don't see a blow off top this year, I don't expect a deep bear market. I really don't. I mean, if we get to like 130 to 150 range this year, I just don't see how we correct more than like 60% at the most. But I would say probably my base case would be more like 40%, maybe 50 at the most, right? Somewhere in that range. So a more shallow bear market would be expected as a result of just not as high of a peak, relatively speaking. Now, if it extends into next year and we get higher targets and we do have a parabolic rally, then that's where we could see that kind of deeper correction of like 40 or 60 to 70%. So anyways, I'll wrap it up there. Sorry about the long rant.
Yeah, well, I was also looking at our viewers. We are fast approaching 3,000 views. A good start after a long pause. I'll end this with a positive note. The fact that a lot of people are taking profit earlier than expected, and a lot of the unrealized gains are being realized as the cycle progresses, this may also be preventing more rapid crashes once the cycle is over. And so these people who are taking profit now, they won't be taking profit later because they're out of the market. So that can be a positive sign and take pressure off the price action a little bit. But we'll see how this evolves. And moving forward, we'll try to figure out more frequent chats like this with prior announcements. And so it's possible that we make this a continual, consistent trend and do this every week maybe. So we'll let you know. And thanks a lot for everyone who participated. Fantastic discussions and different viewpoints. I think if you put all these different views together, what comes out of it would be very, very informative and rich. Thanks again, everybody. Thank you guys for watching the show. And we'll talk to you next time we come online. Thanks a lot. You have a great rest of your day.
See you guys. Bye.
See you guys. Take care. Have a good rest of your day.